Well, there are short-term elements and there are long-term elements. And on a short-term basis, you're seeing some recovery in the electronics industry. You're seeing increased use of electronics in automobiles and in other manufactured goods. All of that is using silver. And you use about an ounce of silver per vehicle. The auto industry, unfortunately, for silver and everything else that goes into it, has been in weak condition for several years and probably is going to continue to be relatively weak this year. You are seeing an increase in electric vehicles. Perhaps another 1% of the market will shift from being petroleum-powered vehicles to being electric vehicles this year. So that will increase the use of silver, maybe 1 million ounces. It's not going to put the world on fire. Solar power continues to increase, and that will continue to use more silver. So you're seeing some strength in the demand. Obviously, if we go into a recession, that could upset the apple cart, and you could see electronics and auto sales and solar power and solar panels all decline or stop growing as strongly as they would otherwise. So that's a real risk that you have with a recession with any industrial commodity, And then silver, if you were talking about the price, you're really talking about investment demand. And there it's going to be a matter of, can you actually effectively market silver to investors who have been disappointed by the fact that silver is not $500 an ounce? And I think you can. I'm not sure that the silver market and silver industry is set up to do that. But I do think it's a real issue that's a possibility. And that could actually strengthen the silver price.
If we see that investment demand come in?
Yes.
All right. Mm-hmm. So maybe we can talk a little bit more about recession, because specifically in the US, we have these concerns that the Fed will hike too far, cause a crash, cause a recession. You actually told us multiple times last year, I believe, that the Fed could go quite a bit further than a lot of people thought that it could. And after 7 rate hikes last year, I wonder what you see coming in terms of its path forward in the year ahead.
Yeah, the Fed, in fact, has pushed further than a lot of people thought it would or could, and we still don't have a recession. We had 2 quarters of negative growth in the first half of 2022. We had 2 quarters of relatively strong growth in the second half of 2022. We're probably going to have 2 quarters of negative growth and 2 quarters of relatively strong growth in 2023. But the Fed has already increased interest rates more than a lot of naysayers thought was possible without throwing the country into a recession. And one of the points we keep making is that we are worried about a recession, but we look at the drivers of a recession as being fundamental supply and demand trends in the real economy and fiscal policy. Monetary policy is a distant third. It's highly unlikely that monetary policy would trigger a recession. What could trigger a recession is abrupt changes in fiscal policy, which is a machine that's been broken for 40, 50 years now, and reversals in the real economy that have nothing to do with government or central banks. So we're a little bit worried about that. Our expectation is that the Fed will probably raise interest rates another 50 basis points in 2 hikes over the first quarter of this year, that it will then most likely plateau interest rates and not raise them after March into the fourth quarter, at which point you might start seeing the Fed reduce interest rates of 25 basis points once or twice in the final quarter of the year, as we slouch toward a recession stimulated by fiscal policies gone awry and real supply-demand trends for both goods and services in the real economy.
Okay, I'm curious to know what you think of the Fed's timing, because we hear quite a bit, they were too late to start hiking rates. Maybe now they're going to be too late in reining them back in. How do you think they're doing when it comes to timing and tackling inflation?
Yeah, William McChesney Martin, who was the chair of the Fed from I think 1950 to 1971, probably the best central bank chairman we've ever had. He used to say that the Fed's job was to lean into the breeze of inflation. And this Fed, which I think has been much better than, say, the previous two Feds, failed to lean into the breeze. And they let the breeze turn into a stronger wind before they started leaning into it. And they've taken criticism across the board from that for having done that. But I think that they caught on to what they were doing and what they needed to do. And I think 2022 proved that the Fed could catch up with itself and catch up with the real economy. And, as I said, you saw a very weak first half of the year. And then you had a much stronger second half of the year, even as the Fed was raising interest rates. And I think that observant, empirically driven investors would take note of that and say, okay, those people who are saying that the Fed's going to raise interest rates so high as to throw the world into a recession probably don't understand the relationship between monetary policy and real economic growth.